And considering that startups have been, the kind of exponential growth we are seeing in a lot of startups, it's a very lucrative investment option also, because a lot of our members might be interested in startups as an investment avenue as well. So if they wish to become angel investors, they can do so as well. And there are a lot of platforms, a lot of groups, syndicates, which are actually helping individuals to come together and deal and invest in startups in an organized manner. Then government grants, which is the most, I think, favorite of everybody, favorite source for everyone, every kind of business. Because it's a grant, there is no, mostly it's either subsidized or there is no repayment, or the repayment terms are so simplified that it is obviously a very lucrative option. There are central and state government grants and schemes like Stand Up India and multiple other schemes. There's a new scheme launched this year itself, which is Startup India Seed Fund Scheme, which we'll cover later. And these provide financial assistance in the form of grants or tax credits. Then equity offerings, they can issue their shares directly to public or even to private investors, and they can raise substantial amount of funds provided they are eligible for getting listed on a stock exchange. As I already mentioned, IPOs are used when companies have profitable operations, their management is stable, they have been in operations for more than 3 years. Even the market making by a registered merchant banker is required for at least 3 years. There's a turnover requirement. So a lot of these requirements are there, and then you have to comply with the SEBI listing obligations and regulatory procedures, disclosure norms, everything. So IPOs is one of the steps taken by very large companies after they have raised and they have gained a certain stability in their income and they've established their presence. Then there are warrants or bill. It is basically like security which grants the owner the right to buy stock in the issuing company at a predetermined price at a future date. So if you decide the price on which you will buy the share today, which you might be buying after, which you might be converting into stock maybe 5 years, 3 years, 2 years down the line. So that's basically a warrant or a bill. Then, of course, the bank and other commercial lenders. This is the most traditional form of raising finance. There are commercial finance companies, NBFCs, and financial institutions. And the businesses which do not have substantial personal assets or collateral can, rather than going to a bank or an NBFC, they usually go to commercial finance companies as well. It may not be the best place to secure financing, and the terms are usually quite harsh and very, very, so to say, difficult to comply with, but and the cost of is obviously very high. But for people who are not able to raise funds from banks or NBFCs, they come to commercial finance companies as well. Then the bonds and debentures. So it is different from debt financing. How? Because the interest rate and the company will pay back the principal. Those terms are quite different from regular debt financing. So bonds and debentures can be issued. And then for debentures, there is a separate list of compliances which need to be taken into account, which is basically appointing a trustee and a lot of other requirements which are there. Then comes the lease or rent. It's not really fundraising, but for any kind of purchase of or investment in any fixed asset. So for lease or renting of an asset, it's basically you enter into an agreement between two parties for using of that asset or the rental on a rental basis. It has to be a tangible resource. It can be a building, it can be a plant and machinery, it can be equipment. So leasing, renting can be one form of getting money to invest in a large asset without really paying upfront. Then comes the commercial paper. It's a very short-term, way of raising debt, usually used by large companies, already existing companies, which is unsecured, issued at a discount from face value and reflects the prevailing market interest rates. Then comes the bank overdraft for working capital. Banks issue OD limits, CC limits when someone withdraws more money from their account, and then it is available on a regular basis. Now, usually you have to submit your documents to the bank for availing these bank overdrafts and loans, and there has to be a successful run rate of at least 12 months for you to be eligible, for any company to be eligible for a bank overdraft generally. But yes, right now the norms are actually becoming a little more difficult as well. So for some banks, they have actually increased that time limit as well. Uh, they mention 6 months, but it's never 6 months. So you have to have a successful runway of at least 12 to 18 months. Now, bank overdraft is usually there's a limit attached there, and mostly just to give a rough idea, for most banks it is for the next 3 years financials or the next 12 months financials, the turnover which you show in your provisional financials, basically up to 20% of that you can raise as a bank overdraft. This is a rough rate which on an average most banks will give the overdraft on. Then comes asset-based financing, basically mortgaging your physical fixed asset like land, building, machinery, or factory. There's something called agreement for sale, under which also it is a kind of asset-based financing as well, where you give an asset that you already have, and based on the value of asset, you can raise some working capital, and then you have to keep renewing that agreement from time to time. Then comes a private placement. It is basically a sale of securities or shares to a relatively small number of investors as a way of raising capital, usually large banks, mutual funds, insurance companies, and also institutional investors. Can be other kinds of finance companies as well who invest in large companies, and usually the stake is held by a very small set of people or individuals, and this private placement happens. It can be done even through, PE funds or even family offices. Now, these are the stages of fundraising for SMEs. So at an initial stage, which we call the pre-seed stage, seed stage, or startup phase, when the company is not yet uh, launched their operations in a full-fledged manner, but they are yet to stabilize and grow their operations, and mostly running in losses, right? So at that stage, there's promoters funding, there's venture capital, private equity. Eventually down the line, they can even go for, at the time of emerging growth, they can go for SME IPO, which we will also cover briefly. And then there's migration to main board. Now we're just going to cover a few of these options, and in a little bit of detail, which are available to startups in India. Hopefully, so far, I hope my speed is not too fast. I just want to take a quick check on that. Hope everyone's understanding with the flow currently going.
Going absolutely amazing, ma'am. And
Thank you.
yeah, very, very knowledgeable, and many of the doubts have been cleared also, I think, I'm sure, for the members. So you may
Great.
continue, ma'am. If anybody having any kind of doubts, please put in the chat box.
Yeah,
So we
please
can
do,
take it up
please
in
do.
the air.
And you can also connect on LinkedIn later if there are any doubts, anybody has any queries related to what I've just mentioned throughout the presentation. If there's anything, we can connect over LinkedIn. So I'll just give a detailed view on fundraising options which are available. Few of them we will cover. Like one of the most, I would say, hot topics right now, with startups are willing to or looking to find out and how they can, adapt to that, or get this avail this option, is Startup India Seed Fund Scheme, which was introduced this year itself. This is a very new scheme. It's a very new option of raising finance for seed stage startups. Now, what is Startup India Seed Fund Scheme? Now, DPIIT, as we already discussed, has created a Startup India Seed Fund Scheme with the outlay of 945 crore rupees to provide financial assistance to startups for proof of concept, prototype development, product trials, market entry, and commercialization. So basically, this fund is established for early stage companies who are still in the product development stage. And for these multiple areas, they can raise finance through this scheme and this fund. They're looking to support 3,600 entrepreneurs through 300 incubators in the next 4 years. Now, the Honorable Prime Minister of India has also announced that, his in the scheme of his grand plenary address of Prarambh, which is the Startup India International Summit, that this approval about this fund and the approval of EFC, and the finance minister also has notified the scheme on 21st of January this year. But the scheme has been introduced but not yet launched. So we will see the applications being made from the month of July, hopefully. The portal is already there. The portal is already existing. If you search for it, you can find it. So Seed India scheme, and then it's a subdomain of Startup India. You'll find details on Startup India website as well. And this will be disbursed to eligible startups through eligible incubators which are registered. Now, these incubators can be government incubators or even otherwise private incubators. Now, the objective is obviously to provide the financial assistance to startups for proof of concept, prototype, product trials, market entry, and commercialization. So they will enable these startups to graduate or to grow to a level where they will be able to raise investment from angel investors or VCs. Now, what is the need for Startup India? Obviously, at this point, considering the pandemic, considering all the working capital crunch and the cash flow situation, easy availability of capital is very important for entrepreneurs, especially at an early stage where you need to invest a lot of money and time and effort into building the product, right? And funding from multiple investors becomes available only after there is a certain product being launched. There's a proof of concept which has been provided. Similarly, banks provide loans only to asset-backed applicants, which we have already seen in the last 2 years, 3 years. Even if there has been a secured, there are clients, there are people who have been looking at applying for bank loans, but because of multiple issues, banks have not been granting these loans or not being extending their limits. So it is essential to provide seed funding to majorly to startups who have an innovative idea, which is technology backed, and to conduct proof of concept trials. How will this fund operate? It will be disbursed to eligible startups via the eligible incubators. Now, there's a list of incubators who have been recognized all across India. As we already mentioned, around 300 incubators are there. And Department for Promotion of Industry and Internal Trade, DPIIT, which is the nodal department, will have an experts advisory committee, which is consisting of government representative and experts, and they will be assisting these and helping and giving money to these incubators who are government assisted or even otherwise private incubators for and this is really important, the incubators only which have been operational for at least 2 to 3 years, because they do not want to give money to new incubators which do not have any proof of working or activity done in the last 2 to 3 years. Now, these incubators will put money based on the selection criteria, based on the compliances and the eligibility criteria stated by the experts committee, to startups which are DPIIT recognized and incorporated, which are incorporated less than 2 years ago. Only startups which are incorporated less than 2 years ago can apply for the seed fund. If a startup has already crossed a threshold of 3 years, still recognized under DPIIT, they cannot claim for this. They cannot apply for this. Now, what is the eligibility criteria for the scheme? For startups, this is very important for us to understand. For startups which are recognized, incorporated not more than 2 years at the time of application, one is that. Second, it must be a business idea to develop a product or service with a market fit, viable commercialization, and scope of scaling. Now, each of these words have a very wide meaning and very much open to interpretation. So if it's at this point, it is only open to interpretation, and multiple other things will come out in this, but we have to wait and see as they start granting loans. We will see then what exactly are they considering as eligible uh, criteria, eligibility criteria for this kind of business. Now, startups should be using technology as core product. We have already established that. Preference will be given to startups which are creating innovative solutions, not like a Me Too product, but something innovative, something disruptive, something really new and solving a problem existing in the market. Anything with social impact, waste management, financial inclusion, water management. When I say financial inclusion, it may involve, it can include P2P lending platforms as well, or platforms which are actually helping the marginalized societies and sections of society to raise funds, or granting funds to them. For education, agriculture, food processing, biotechnology, healthcare, energy, mobility, defense, space, railways, oil and gas, textile. These are the listed and the preferred sectors, but they have made the list all. It's not an exhaustive list. There is, there are covering other sectors as well. They are trying to cover every other sector. Depending on the kind of startup that comes, they will be considering the eligibility. Now, startups should not have received more than 10 lakh of monetary support under any other government scheme. So if you have raised under Mudra loan or any other kind of monetary support under any government scheme, it should not be more than 10 lakhs in last 2 years. So, and this does not include any prize money from competitions and grant challenges. In a lot of colleges, there are a lot of competitions organized by the state governments or central governments, challenges, subsidized workspace, and allowances which are available under with incubators. So those are not involved. Those are not included. Only if there's a cash or a monetary support of 10 lakhs or above, only then they will be not eligible. Otherwise, it's completely fine. Now, shareholding by Indian promoters should be less, at least 51%. So it should be an Indian company by its status. At least 51% should be held by Indian promoters at the time of application to incubator. And the startup applicant can avail seed support in form of grant or debt or convertible debentures, each once as per the guidelines of the scheme. One thing which is not mentioned here, but you can check, and of course going forward with the schemes and the details that will be released, which are yet to be released by the government. There's a limit of around 20 lakhs for product development, which is in the form of grant, and there's a limit of around 50 lakhs in the form of marketing expenses or any kind of growth related expenses for startups. Those are the internal limits, and again, limits for multiple types of categories of deployment of funds. But with these limits for the product development, it's purely a grant. There will be no repayment of that amount. For the marketing expenses or for any kind of fundraising for marketing or growth point of the startup, in that case there will be a repayment, but it is at a very nominal interest rate, somewhere around 4 to 5%. Now, for incubators, there's another list of eligibility criteria. It should not be, less than 2 years old. It has to be more than established, more than at least 2 years back at the time of application. Startup should have one second. I think this is a repetition of this. Sorry. Yeah, this is a repetition of the incubators, but they have these eligibility criteria for allotting the amounts to incubators. And then, as already mentioned, the incubators are eligible for, once a startup gets recognized within incubator, they will be eligible for granting of these funds under SIFSS. Now, coming to the next point, which is investing in startups via VC funds or angel investors, right? Okay, I think we missed a slide here. Sorry about that. Now coming to this, we're talking about angel investors and VC funds. Now, just to explain the concept, like how before buying a new vehicle, we usually test drive it, and it is tested, even though the vehicle has been tested on extreme conditions, on land, on different terrains and different kinds of conditions by the manufacturer. Still, an investor, before they decide to invest, would like to know what are the kind of tests the startup has gone through and how will it survive, right? The testing times, when the testing times show up. So testing the idea is very important, and that is pretty much a part of the due diligence that they do. Now they test the viability of startup using different parameters with the numbers, the marketplace, what is the size of the market, the competitive edge, and all the fatal flaws. They test the idea from marketplace perspective, competitive edge perspective, which is how many competitors are there, and understand the various risks associated with it. And does a startup have a plan to mitigate those risks? Now, these are some of the seed financing instruments or securities, types of securities or instruments through which startups mostly raise seed financing. One is equity, which is the most popular way of raising finance. There's preference share also, which is usually convertible preference shares, which later at a later date will be converted into equity, and which is preferred in terms of preference of payment. Preference shares get upper hand over equity shareholders. Then comes the debt funding, which can be secured or unsecured depending on the situation. Government grants, convertible bonds, convertible notes. Convertible notes is a form of security which is not exactly debt, but it will be converted at a later stage into equity on a prior pre-decided terms. And then ISAFE, which is a very new, I mean, it's not exactly new, it's 2 to 3, more than 3 years old, introduced by Y Combinator, which was an incubator in US. And now it's being adopted by a lot of investors in India as well, which is basically, it's similar to a convertible note or a convertible form of raising finance, but it is not exactly debt. So it's a simple agreement for future equity. That's the full form of iSafe, and it's one of the most I would say newest things to happen, and to ways to raise finance in the startups. I'll just briefly take you through, though it's not related to compliances, it's not related to ways of raising, but yes, pitch deck I thought I should cover briefly in the entire space to give you a good idea about what exactly consists and what exactly is a pitch deck and what exactly are the components of a pitch deck, which you should keep in mind. And you can suggest the startups you're working with on how to get a pitch deck made. You can take support of existing companies and corporations who are helping startups with creating pitch decks, and create or maybe create them yourself. So that is my screen visible?
Not yet.
Okay, just a second. Is it visible now?
Yes.
All right, just a second. All right, this is just a small, you can say, illustration of what is included in a pitch deck. Pitch deck is basically a presentation that a startup will share with the investors at an initial stage, through which they are able to communicate the business model and the idea to the investor and create their interest in investing in the startup. So what does the document involve? This is not it's only a format. This is not exactly a pitch deck, but this is only inclusive illustration of what a pitch deck should include. And this is created by Entrepreneurially India, and I'm very much associated with the Entrepreneurially India for any kind of work we do for startups, which is basically an organization helping the startups from end-to-end support. So this is the pitch deck. What exactly is an investment pitch deck? It's basically a brief presentation which provides the investor with an overview of the business, whether it is showcasing the product, sharing the business model, or giving a look in the monetization strategy or revenue model, right? And introducing the team. Now, here the presentation begins. It's mostly very graphical. It has to be very attractive and very graphical looking. So it is important that it's not just the content which matters, but also the presentation which matters in the case of a pitch deck. Now, starting with the table of contents, what all areas we are covering in the entire pitch deck, we can start with that. Then a brief introduction, talking about the product. Then talking about the company, basically stating the vision, mission statement, and the objective of the company, stating the company logo, tagline. Then talking about the team. The founders, who all founders are there, we can talk about their experiences, we can talk about their education, we can talk about their past success stories. Then we talk about the problem we are trying to solve. What exactly is the issue or the pain point that the startup is looking to solve? Then coming at the competitor analysis. In between, there can be one more slide stating the solution that we are offering, but we will cover that later. Then comes a competitor analysis. With every space and sector, if you look at, now you will find a lot of people already doing something similar. So if you're a health tech startup, there might be 5 other startups doing similar things, not exactly same, but working in the same user base or working in the same field. So we do a competitor analysis, highlighting what are their positives and negatives and how are we solving them. Then comes a solution, talking about what is it that we're offering and the features and the benefits. Then we can do a SWOT analysis, which is basically strengths, weaknesses, opportunity and threats, multiple points that get covered under SWOT analysis of our product, of our startup. Then the product overview, if there's a product, if there's a technology-based platform or a product, we can talk about the product and the multiple characteristics of the product. Then pricing arrangement or the revenue model. Then a product demo would be good if there is a product demo available. If not, then it's fine. And we use more pictures, like I already mentioned. A picture is worth 1,000 words. So we use more pictures, more graphical details, and more try and make it as interesting and as attractive as possible. Then talking about the market and competition, which is very, very, very important. Talk about the traction that the startup has. Now, in the last 6 months, what the numbers have been looking like, what has the sales been, what has the CAC, which is customer acquisition cost, been, what has the GMV been, which is the gross merchandise value of basically value of goods. Also, all these are technical terms which we can place as stating the current state of business, basically, which reflect the current state of business, right? So we can talk about traction in last 6 months, 12 months, what is the growth every month like. So all those numbers can be presented. This is just a illustration stating that the important numbers should be highlighted in large fonts and should be presented in a very clear manner. What is the market size? What is the number of users we have? All those kind of things. Then we can have a case study of the user, our target user or our target customer, how we have helped them and in achieving the results or giving them a solution. Then we talk about our awards or rewards or any kind of challenges, competitions the startup has won. We talk about the market size, the value of the market size at the present, and this has to be very, very detailed, researched value. Cannot be a number you picked up from internet, has to be very well detailed, researched. Then the target that we are looking to achieve, basically what is the our target customer looking like, what is the average spend they do, what are the benefits we provide, so those kind of things. Then we talk about the major competitors we have, the business model in multiple parts of the business model. 3 years, at least 3 years financial projections should form part of the pitch deck. This is the area where CAs can really, provide their expertise, where we are helping them create a financial model or financial projections for the next 3 years to 5 years. And on the basis of that, valuation is also determined for the startup at that point, based on which equity will be granted. Then the predicted growth, which is again based on the financial projections. What will be our sales in the next 5 years looking like? Then we talk about investment. What is the amount of investment? Let's say, for example, 10 crores is the amount of investment. We mentioned the total amount. We mentioned the breakup of the amount. Where are we going to deploy these funds? The 10 crore, if we're saying, okay, 2 crores, we will hire more people. 3 crores, we will invest in product development. 5 crores, we will invest in marketing activities. So in that sense, a complete overall picture of where the funds are going. And then we can end the pitch deck with the contact details, which is quite important. Though it was not technical, but I hope this can be of some value for and similar formats. Already CAs do use similar formats for project reports, which we use for bank loans and project loans. So it's pretty similar, but for startups slightly different, because every kind of startup has a unique proposition, unique value, unique problem they're solving. So it's important to highlight on those factors. Coming back to our presentation,